it's not a lecture or I don't have slides for you. So, I just thought that I was told that I'm talking to an audience who is probably looking to get into a proper paid job maybe this year or next year. So a lot of you would be starting your careers, getting sizable salaries to take back home, and maybe that's the reason personal finance at that point in time becomes something that's good to know, so that some decisions can be taken in a better way. Having said that, it might seem like, I was always a personal finance guru, but no. So when I started my career out of MDI back in 2012, I was pretty much like everyone. So, despite the fact that I through and through I was a finance graduate. So even in my undergraduate years, I was pursuing finance as a specialization. In MDI, I took finance as a specialization. But, unfortunately, neither in school nor at home and nor in college, we are taught about anything related to personal finance. We are taught about derivatives, and we are taught about, so many products and strategies, but we are not taught about the very basics of how do we manage our own money. And that's one reason why a lot of us end up not doing anything about the money that we earn for many many years after we start working. And it's only after someone touches early 30s and crosses maybe 32, 33, 34, that they start to realize that, oh my god, I've been working for 10 years and mere paas to kuch bhi nahi hai, right? So this is a thought that's very very prevalent amongst a lot of people who start working, and that is when they really take this leap into checking out what all can I do with my money, where should I invest, should I invest, not invest, how do I buy a property, and so on and so forth, right? So today's session, what I'll do is I'll speak about I have collected my experience of first 5 years of my working into a few mistakes that I made, and these are very very common mistakes. I don't really beat myself for it, but it's good to know what not to do, right? So there's a lot of things that we can do, but if we know what we should not do and where we should not go, the decisions are easier to take. So the session today is just me talking about 5 mistakes that I've made, and maybe a little bit about my story of how I landed up in this profession. And then we'll open up for Q&A. If you have any specific questions for yourself, happy to answer that, right? So one mistake that I made when I started working. So just to give you some context, before pursuing my management graduation, I was working for one single year, like back in my hometown, but that wasn't really a well-paying job. That was more for an experience sake. So JP Morgan, where I got placed after campus, was the first big job that I landed, and that was the first sizable money that I earned myself, right? So what I did not ever do is note down my expenses. So while I knew what am I getting every month, what I didn't know is what am I spending on. So yes, I knew what my rent is and what am I paying, the house helps, but what I didn't know is how much am I spending on things like eating out or meeting friends or shopping or traveling, or like these kind of things. And I had no idea that if I'm making X amount in a particular month, am I saving 20% of it or am I spending 50% of it? I had just no idea. So what was happening was that the balance amount that was left every month, it was just accumulating in the bank. And because I had no idea what that amount every month was, there was no tally that I was really doing. Um, it never really struck me that I should make use of that surplus, right? And this is a mistake that not just I made at that point in time. Even when I speak to a lot of people now, a lot of people don't have an idea of what is the level of spending they are doing. And one of the complications in this is that, after you start working, there are so many credit card companies that will come to you and sell you their credit cards. And we often own a couple of them. And because all our expenses are generally charged to the credit card, all we know is what we are paying every month to the credit card company. So the bill, the credit card bill, whether it's 30,000 or 50,000 or 1 lakh, but you don't know what we are spending on. So a lot of people whom I talk to even now have no idea what they are spending on entertainment versus groceries versus utilities, those categories. And it's a great idea to start doing that early on. It not only gives you an idea of what is your spending behavior, but it also gives you a lot of insights on, is there a behavioral change that you need to bring in yourself, or if there is a particular kind of a spending pattern that you have, and if that is a good thing about you, or that's something that you need to improve upon. So this was the first mistake that I think that I made. The second thing that I did wrong, that I feel now, is that I was always prioritizing short term spends, right? So, say for example, if I had to travel for a vacation, so I always felt convenient to keep money in the bank, because I always felt like, what if I need it for something, right? So, this what if situation, that you feel that, okay, I might travel to Goa, so I might need this money, and I might buy this thing, I might need a phone, I might need a laptop. So all of these short term things, that we do, leads to a lot of ambiguity in the way we manage our money, and it always feels convenient to have everything accessible. So a lot of people have a lot of difficulty in creating some inaccessibility to their money, parking their money away for the long term, being comfortable with the fact that they are not going to touch this money, right? It felt very difficult to me at that point in time, because I wanted to fund a part of my wedding, and I wanted to, fund a lot of things. I was pursuing CFA at that point in time, and it was the first time I was really living alone, away from family. So I was always confused that, what if I need to buy some stuff for the house, or what if I need to buy some clothes? And so I always wanted that extra liquidity in hand, but that was a lot of liquidity, right? So recently I spoke to somebody who had been working for around 10, 12 years, and they had around 40, 50 lakhs sitting in the bank. And, when I asked that, why have you not even put it in an FD or done something about it? They said that, I thought that maybe what if there is an emergency? So there has to be some kind of a line that we need to draw in terms of what is that emergency fund that we need. It cannot be 50 lakhs, because if it's 50, then why not 1 CR? Right? So there's no end to that. So what it does is it drags your entire money down to a level where it's not even beating inflation, right? So that was one thing I did. I always wanted to see my money in the bank. I wanted to be, like have it fully accessible. I wanted that if I'm going to a department store and I swipe my debit card, I don't need to think about anything. So that behavioral problem is a trade-off that I made at that point in time, not knowing the cost that it is going to create at a later point in time. The third thing that I did wrong was something that all of us are going to face. So all of us will be, in the 30% tax bracket, and all of us have to make tax saving investments. And like everybody else, I used to think about tax saving investments only, in January, February, March, when they used to ask for the documents. What it does is, generally, in any job, we are very, very tied up with the work pressure, the meetings, the deliverables, and we usually don't go back and spend time on what we are working so hard on. We don't spend time on the money we are earning. So what happens is, when the call for the documents comes from your employer saying that, we need to see what investments you've made and show me those tax saving investments, all you think about is, okay, what can I do quickly about it? Because you don't have the time to think about and the research and the analysis to, whether an FD is good, or should I purchase an NSC, or should I go and do PPF. A lot of people don't even know what all tax saving investment options exist. And this is the time when a lot of us end up purchasing a lot of LIC policies for ourselves, right? So, and if you actually speak to people who have a lot of these LIC policies when they are working, all of those would have commenced in January, February, and March, because people did not have the time to think about what they should be doing. So what I did was I used to do 5-year FDs, which now I feel very, very stupid about. I could have done so much more in terms of tax saving investments, because in the first 2-3 years of when I started working, tax saving investments were the only investments I was making, because like I said, I always wanted to see everything else very near to me, right? So that was the only investing that I was doing. And if I were to talk about it now, that wasn't even investing. I was just putting it in an FD, right? It didn't grow. So nothing that I earned in the first couple of years grew beyond a point that could make me feel like my money has grown, right? Whereas a couple of other people who were smarter than me in this respect did take some right money decisions with their money, and they ended up having a better net worth with the same salary, but because of better behavioral habits, they had a better net worth than I did after 3 years of working, right? And now when I'm in this profession and I talk to a lot of people, the same kind of pattern I see even after 10-12 years of working. So this was the third thing. So tax saving investment is something that you should start thinking about as soon as you start working, not wait till January or February or March or till the year end, because procrastination is something that comes very, very naturally to most people. And this is something, if we can beat it, we can take better decisions around which tax saving investments should we be doing. The next thing that I think I did not do right was, understanding the real implication of compounding. So we have all, read about compounding. We all know the maths, how it works, and but what we don't really understand is that how does inflation and compounding really eat into our real lives, right? So we don't understand what will happen if I keep putting my money into something and taking it out versus taking a long-term investing decision. So the fact that we are not able to visualize long-term, like I said, I used to keep my money available for all short-term expenses, a phone, a laptop, a shopping, and some money here, some money there, some emergency. I was never able to think about what is that wealth that I want to create 20 years down the line. I never thought about how compounding really works on money, right? So for a lot of us, we understand this concept in fitness. So a lot of us would understand that, we cannot become fitter overnight. Probably fitness is a function of the right diet plus workout plus habits plus behavior over probably years and years, and then it becomes a part of your life, and then that's how you become sustainably fit, right? Compounding as a logic works with everything in life, whether it's money, it's fitness, it's relationships, it's profession, everything in life. But we don't really understand the real impact of compounding, how it really implements in life. This is something that was I think a blunder at my part, because I was also pursuing CFA at that point in time, right? So these concepts of time value of money and compounding, I knew all this, but I was doing nothing about it. So how is it possible that when I know everything about it, yet I'm not implementing it in life? The reason this happens is because we don't really understand the impact of theoretical stuff in our real life, right? We don't really see it. So what happens if I don't invest my money, if I don't put it to use? What happens if I am lavishly spending on online shopping apps, right? So what happens? So this is not a thought that we really put into place, because the fact is that with the kind of salaries that we start getting after a good management graduation, we get very comfortable in life, right? So it's not very difficult to afford a place and to have the right home structure and also take care of your needs. So all of us in the present kind of become financially independent, and that is what prevents us from thinking what will happen when this money will stop coming in, what will happen when we will retire, what will happen when we need to buy a big house, or what, not even a big house, just a house, what will happen when in the future we'll have to fund our child's education, and or what if we want to start a business, how do we accumulate capital for that, right? Or can we prepay our education loan, for that matter? Like for a lot of us, we take education loans to fund our MBAs, and we are very comfortable with the EMI that's going on, and not a lot of us think about how can I prepay this so that I can make better use of this EMI elsewhere, right? So these are the kind of things that we don't think about, despite the fact that we understand all of these conceptually, but we don't understand these practically. Now, bridging this gap is very, very important if you really want to be on the other side of the table in terms of money management, right? A couple of years back, we had done a survey as part of this business. We had done a survey where we spoke to a lot of people who were above 50 years of age, right? And the way we had selected this population size was basis the fact that all of them were making the same kind of money when they were in their 20s and 30s, had the same kind of family structure, same kind of spending responsibilities, same kind of goals. Yet, surprisingly, what we found is that once they were 50, 55, 60, a lot of them had very different kind of wealth structures and lifestyle when they had reached that age. So the point that we were trying to figure out is that despite the fact that all of them started equally at an equal footing, how is it that some of them landed up differently? How is it that some of them retired uncomfortably versus some of them retired very wealthy versus some of them being at a mediocre level? So when we ask them about, what were the things that you did in the last 30 years or 40 years of your working, so the kind of statements they were making, we realized that there are a lot of behavioral aspects in how we manage money that determines how we really end up in life, right? So it's not about knowing things conceptually. It's not about being a finance person. It's not about understanding the maths behind it. It's about understanding your behavior in terms of how you manage money, and taking and avoiding those those mistakes and wrong decisions. You don't need to be right in everything that you do, right? So somebody who has, say for example, purchased a Zomato stock, it's okay if they are wrong, but if they are avoiding the major blunders that they make when investing, most of them would end up fine in life, at least comfortable in life, if not wealthy, right? But everybody who has ended up uncomfortable in life has definitely made some financial blunders in terms of decision making. And this happens because generally at a younger age, we are very, very optimistic about our future. ये कर लेंगे, वो कर लेंगे, हम अपना business भी कर लेंगे, हम बहुत बड़े हो जाएंगे, and it's good to be optimistic. But the good part about financial planning and like thinking about your finances is to plan for the worst case. And if you are anything better off than the worst case, you'll always be happier in life, right? So money is very, very closely integrated with life, and it's not about money that, like how wealthy you are or kitna return aayega is not something that any of us should worry about. We should worry about how do we make use of what we are earning for what we are working so hard in a way that, when we need the money for various things in life, it's available. And life is comfortable at all points in time, even when you are 80 years old, right? So this was the fourth mistake I was talking about. The fifth mistake that I made was, never having any clarity about what are my financial goals. What is it that I'm saving towards? So even when I started investing, I didn't know that, do I want to save for a property or do I want to save for my retirement? Because, when we don't write down our goals, it's very difficult to understand how long we are willing to invest and how long are we willing to leave our money invested, right? So that is something we don't really think about. And we are not able to map our money to certain goals, and we are not able to get a hang of how much risk should we be taking. So, it's very easy to feel that, now that I have money, I can start investing. Let's just go straight ahead and buy Bitcoins, right? Even though I have not done a single FD and I've never done mutual funds, I've never done equity, but let me go and buy Bitcoin because wahi paisa banta hai. So it's very easy to fall into the trap of returns, not understand risk, and not understand this whole time horizon thing, right? So writing down our goals, that what is it that we want money for in life, whether it's a car, it could be an international vacation or a domestic vacation every year. It could be a part of, it could be a fund that you want to create for your parents. It could be paying off your education loan. It could be a property. It could be a marriage, anything. It could be 15 different items. But writing them down on paper will give you a lot of clarity about what all you need money for. And that kind of prevents you from mismanaging your money early on, right? So these were the 5 big mistakes that I felt I made in the first couple of years of my working. And since I had already made these mistakes, and I somehow, like after 2 3 years of working, I started to get a sense that, I have not done everything right with my money. And when I started speaking to my colleagues and friends and uh, cousins who were, working in similar profiles and in the similar age bracket, I started to feel that there are so many of us, right? Nobody is right with it, and nobody knows anything. So, that's when two of my other partners were now, two of my other friends were now partners with me in the business. That's when, we started to discuss personal finance amongst ourselves. And we started to have this conversation of why we are not making, this conversation of how much we are saving every month. What do we need? What is this whole financial independence thing? What is this retirement? And these kind of stuff that we need to. We started talking about this, and then we started talking to a lot of our colleagues and friends about what they do with their money. And that's how we realized that there's a big gap in the industry. And that gap is not only about awareness. That gap is about awareness, trust, behavioral deficiencies in people. And that's when we started to start CAGR funds as a side project. And we came together. We And at that point in time, we wanted to be this tech startup who has a tech platform for for making people invest in mutual funds. We did develop our online platform, which we still use it. And we started to realize that a lot of people have a lot of different kind of personal finance problems. So someone wanted to accumulate capital for a business. They didn't know how to do that. Someone wanted to pay off their loan. Someone wanted to, someone had no responsibilities and they wanted to just grow their money for the future. Someone wanted to fund a medical operation in their family, which was very expensive. So everybody had a very different kind of a problems. And some people just wanted us to help them understand how to manage expenses better. Even things like that, there were people who told us that, if money is in my bank, I'll spend it. So what do I do about it? How do I just put it away so that I don't spend it, right? So that's how we started CAGR funds. We started handling individual clients. We started managing their portfolios, started telling them, the various mistakes that we should be avoiding. And at that point in time, it was more of a passion project. But as we started getting more clients, so we have till date only grown through referrals. So we don't function like a startup. We are completely bootstrapped. As of today, we just completed 6 years 2 days back. And as of today, we manage wealth of around 70 to 75 crores.
Shruti, we are not able to hear you.
I think there is some connectivity issues.
Yeah, I have messaged her.
Yeah.
Okay. Yeah.
Yeah, she is joining again.
Hello.
Are you audible, ma'am?
Yes,
Now you
I'm
are.
back. Sorry, I lost my connection. Yes, so the only thing that we do is understand individual concerns, understand what is the exact problem that people are facing with money, what is it that they want to achieve, and cater to that solution accordingly. Um, I was personally never, I was not somebody who was very clear about pursuing entrepreneurship as a journey. I was very happy in the role that I was in while I was in Mahindra and Mahindra, and when I started CAGRfunds. But I was very happy with the role that I was doing, and but then I was happier with the fact that there was so much responsibility on myself. I was catering to people whose entire financial future depended on me, right? It was a very satisfying feeling. It was a feeling that I was giving back something to people, and making an impact to the society. So that's how. And when I used to speak about personal finance to people, a lot of people used to come back and tell me that you seem very passionate about this subject, so why don't you take it up as a profession, and set it up as a business? And that's how I thought of taking this leap. And it's been a couple of years since I'm full time into this. um, I speak to at least 20 people every week, understanding 20 different life situations every week, offering solutions, telling them what I would do if I were in their shoes. And it's been a journey. I like every journey. It has its own highs and lows. There are times when people are very happy. There are times when equity markets don't do well and people are not happy, because not everybody has the idea of how markets work and how much risk they want. So it's a difficult industry, in the sense that more than the money, we need to manage client expectation. But it's something that has, I always feel that this 6 years in entrepreneurship, and 3 years of full-time entrepreneurship, and has taught me so much more than what I had learned in my corporate journey. Because in a job, I was limited to doing a specific kind of work. uh, and here we are a small company, right? We are only a seven member team. So here we have to do HR and marketing, and handle our own accounts, and take decisions around the spends that we need to make. So it's a very different kind of an experience. I always believe that I'm not somebody who can do sales, and that's the whole point. I took finance when I was in MDI, and I have completely changed my view now. So I feel that everybody who has started their own businesses need to do sales. It's a prerequisite, right? And we always do sales. every time we sit in an interview, in a way, we are pitching about the skill set that we have and how we are the best fit, right? So these are the kind of things that I learned when I started my own journey of entrepreneurship. And yeah, and it's been a great journey, and I am completely enjoying it so far. So I think that's it from my side. I just want to give two small pieces of advice in the personal finance space. One is that if you are, since this is a mile sponsored program, if you are thinking of starting your own, startup or a business or venture, one thing that we often do is we kind of mix up our own money with the company money, right? Because if it's our own venture, everything just feels the same. But I think it's very important to keep your professional capital and your personal capital separate. It's very important to keep saving, even if it's a small number. Keep saving, even if you're running your own business. Because I've seen people run businesses for 15 years and they're not able to invest because every time the money keeps getting invested in the business. And while that's a very good thing, it's important to have your own personal savings as well. It always helps. So these should be two different goals. Your personal savings and your business capital should be two different goals that you need to plan for. That's one. Second, it's very, very natural to fall into the trap of quick money when we start earning, right? Because everybody else, I mean, in life, we will always have people around us who are making or growing money much faster than we are, right? We somehow have to understand that we need to be comfortable with the pace that we have adopted for ourselves, basis our own situation, our own personality, our own risk appetite. Chasing quick money can only be satisfying in the short term. It can never lead to long term sustainable wealth creation. Because somebody who is taking a lot of risk with their money might have zero responsibilities in terms of family, whereas somebody else might have a lot of responsibilities. So a lot of decisions that we take with money, what we generally do is, in that coffee room discussion, when you start working, the discussions center around मैंने इसमें इन्वेस्ट कर दिया, मैंने वो खरीद लिया, तुम भी ये खरीद लो. But what we don't know is कि हमने वो क्यों किया, and हमारी क्या individual situations है, does it even merit to do that for us? So in this whole world where there's so much of noise about so many things, if you are able to figure out what is comfortable for you and what is suitable for you and what is right for you, I think that's a big win when it comes to money management. Not falling into that race of quick money, fast money, easy money, only money, right? So not falling into that race really helps. So this is the only two piece of advice I have since the time I have started working. I think we can open up for Q&A now.
Sure, ma'am. Definitely. Anyone has questions? Yeah, they can raise your hand here. And Kanchit is there. Yeah.
Yeah, so Shruti, I really like the session that you told. So I wanted to know that when we talk about the IPOs, so me being not so much enthusiastic towards finance and don't have the required knowledge. So what are the parameters we should look at when we are investing in IPOs? And secondly, when we are investing, should we bother about the listing gains only, or should we look at as a long-term investment?
So I'll answer the second part first, Sanjit. You need to always understand why are you deploying this money. Are you deploying this money to get some quick returns, or are you deploying this money in a company because you think that company will really do well? So whether it's an IPO or a stock that you purchase in the secondary market, the bigger criteria of investment has to be that, okay, let's take it like this. If I come to you and tell you that, Sanchit, I'm getting listed tomorrow, will you or not listed tomorrow, will you give me money in my business? I want to grow my business. I want to set up an office in Jaipur and 5 other cities. Will you give me money? So you'll ask me 100 questions. Who is your customer? How do you make money? What's your profitability? What's the team like? Who are your partners? I want to meet them. How do you think? Right? So you'll ask me 100 questions before lending money to me, right? When we invest in any business, think about investing in businesses rather than investing in stocks. And when you change that lens, right, that you are investing in a business, you will not think about listing gains so much. And if listing gains is the objective of investment, that okay, I just want to focus on listing gains, then pricing is the only thing you need to think about. That are you paying the right amount of money in an IPO stock, and you feel that there is exuberance that will lead to listing gains? So I don't think there's a perfect answer to that, because if you are thinking, I mean, like, say for example, you bought an IPO stock at 10 rupees and it lists and gives 18 rupees. Somebody is buying it from you at 18 rupees. That somebody who is buying at 18 rupees is obviously believing that it will go to at least 25 or 22, right? But why are you selling at 18 then? So all of us, what I'm trying to say is that all of us have certain amount of conviction and perception of a business, and that perception, conviction can be different amongst all of us. So the problem in stock investing is that all of us generally tend to feel that what I'm thinking is the right thinking. And if all of us can't think right. Understood? So the point is, you need to first be clear that is listing gains important for you, or is wealth creation through long-term investments in very good businesses important for you? So the criteria of evaluation for both are very different. So the criteria does not start with how do I evaluate an IPO. The criteria starts with what's your objective of investing in an IPO, right? Personally, I'm not a big fan of investing in IPOs, because I always feel that we see a lot of and this might not be true for all IPOs, of course, but generally IPOs come when there's a lot of exuberance in the market, and there is a risk of overpaying for a very, very good business also, right? So the business might be great, but if you have invested in a great business at a wrong price, there's very limited upside you might have, right? So you need to invest in a great business at the right price. Having that judgment of the right price is not purely objective. There's some amount of subjectivity that goes into that. So that's an ability that you get, and you cannot be right every time. So when you're doing IPO investing or stock investing, be prepared to make mistakes. And if you're introspecting every mistake, you learn through it and get to that answer.
So should we look at this loss, because all these tech startups who are coming up, they are the loss-making startups. So should we look at the time period by which they might become profitable and then consider an investment as long-term?
See, there's no right answer to that. There are, of course, people who are investing in these companies as well, and these companies have done brilliantly well. I mean, there's a little bit of a hunch thing, right? Of course, you wouldn't want to invest in a company. Say, for example, you think that let me invest in a tech startup today because it will do really well in 15 years. You wouldn't want to invest in the company if you believe that in 15 years it will continue making losses. So you need to have some faith that, okay, if currently it's making losses, at some point, because of these 5 reasons, it will turn it profitable. And that's a very subjective kind of analysis that you do. There's no objective analysis around that, right? A lot of things need to work for that to happen, and a lot of things will work for a lot of these tech startups. Not all of them will do well, but not all of them will do bad, right? So it's a very subjective bet that you need to take, and it's a bet. So with equity, there is no certainty. So before jumping into that uncertain zone, make sure that you have accumulated enough capital for your certain needs. Don't deploy your important capital into a lot of uncertainty, because if you lose that capital, you will face a lot of financial crunch problems in life. So have that diversification right in mind. Yeah.
Okay, thank you so much.
Shovan?
Yeah, hi Shruti.
Hi.
So yeah, my question is about diversification only. So I have seen a lot of people investing in assets like land and property, and there are people also who have invested in mutual funds as well. So what according to you is the right strategy? Like, should we invest more of our, capital into assets? Because land and property, like you have less risk in that area, and they always have an
What makes you say that?
like in past 20 years, like I have seen, especially in my state,
Yeah.
like these
So
assets
see,
are
what
always
happens
increasing.
is, everything is an asset, right?
Yeah,
Even mutual fund is an asset, land is an asset, property is an asset, flat is an asset. Everything can be an asset. Anything is an asset which you think you will sell at some point in time, right? The reason we feel that property is a safe investment is because property did really, really well in the last 30 years or 20, 25 years, right? So our parents have seen that era where property has made money for them, right? Since the last 5, 6 years, we are not seeing property making a lot of money. There is no problem with you investing in land. But when you think about diversification, what we need to think about is that all of us have limited resources, right? We have X amount that we can invest. If we have to invest that X amount, the whole problem with property investment is that generally, if you are, with that limited set of resources, a big part of your net worth then becomes property. So you end up taking a big concentration risk on your portfolio, right? And if you have to liquidate that investment, it's not very easy to liquidate that investment, right? So the problem with land investment is that if you feel that you have been able to find a land parcel which you think will do really well because of some development that's coming up and that development is certain, I mean, of course it's a good investment, then why not, right? But you need to have that analytical sense about it. I mean, there's no thumb rule that land is a better investment than anything else, or equity is a better investment. There's no thumb rule. We all need to identify assets basis our suitability. Why are you investing in that land? Are you okay to lock your money for the next 20 years in that? Are you okay to have that illiquidity in your portfolio? Do you have enough emergency fund in place? Do you have answers to things like how will you, where will you be living after retirement? What will you do with that land is also an important question that you need to answer, right? When do you intend to sell it off, right? And anything that you invest in should ideally double your wealth in 7 to 8 years. So you need to have a sense that whether it will happen with that land parcel, because everything is a long-term asset class. Even gold is a long-term asset class. I mean, it's not like you invest in gold and in 1 year you will definitely earn a lot of returns. It's not like that. So when you think about diversification, think about how much resources you have. Never make one asset class very heavy in your portfolio. With land, what happens is, you can at best invest in 1, 2, 3 land parcels, right? So just think about concentration in land investing versus diversification in the portfolio when you think about where to invest. Yeah.
So, ma'am, generally, most of us have the same profile, right? Means we are going to be the working professional, earning a salary, paying 30% tax around. So, what's the preference for gold allocation? Means, if we go through the history, so returns on the gold has been as par with the Sensex, but still people don't invest in the gold, even to the 30% of their portfolio. So, what's the reason around it, and how much optimum means? Obviously, it's the personal thing, but generally for the people like us who are in mid 20s and who are in a regular job.
So Tushal, actually, a lot of people invest in gold. So maybe people in their 20s don't invest in gold, but if you actually look at the population of India, gold investing is very, very close. It's very sentimental to people. A lot of people think they are investing in gold because they buy gold without any intention to sell it. And if you're buying something with no intention to sell it, it's not an investment, right? So all of our mothers who and parents who go and buy jewelry saying that it's an investment, it's not an investment if you're not selling it at any point in time, right? So the reason it's recommended that again you should not be over diversified into gold is because gold has no underlying cash flow, right? The gold price is a clear function of the demand and supply. How much demand is there? How much supply is there? Whereas, things like equity or land or, these kind of assets can have an underlying cash flow. So on land, you can create a factory or a warehouse and have a cash flow, right? In equity, what happens is there are companies which are generating cash flows, which in turn is, translating into wealth creation or dividends or, some other form for the stakeholders, right? In gold, there is no such underlying cash flow. And that is the reason it is sometimes felt whether gold is going to be a sustainable asset class or not. Now, that's a debatable question. But usually we recommend that, it's not very, so gold looks like it has given very, very good returns in the last few years. There was a period when it did not do very well, but it has done decently well over a very long period of time. So again, it's a long-term asset class. So yes, from a diversification point, you can have gold, but it's not something that you really need to allocate 30% to. Because if you're allocating 30%, you should be confident about gold giving you that kind of a return. It's about your own conviction as well. I personally don't have that conviction to deploy 30% of my net worth into gold. Somebody else could have, right? But having said that, you don't need to think about the perfect diversification when you start working. Okay. When you start working, think about tax saving investments first. Second, think about compounding. Do allocate a certain portion of your surplus to equity, to any other asset that you feel will compound. If you have that kind of a surplus where you think you can invest in any good asset class, like Shovan was asking about land. If you have conviction on a particular land parcel that you think will do well because of certain XXX reasons, there should be these XYZ reasons. If there are no XYZ reasons, don't go by a thumb rule that land is a good investment and a safe investment. It seems like a safe investment because you don't see the land price on a ticker value every day. Otherwise, if you have to list land as a stock, it will also go up and down every day. And that's the reason equity seems risky, but land does not seem risky, right? Ask people who have lost money in land and they will tell you that land or flat, whatever, and they'll tell you that that's also risky asset. Plus, there is risk in everything that we do. There is risk in even FDs, right? So don't think about the perfect, you might not achieve the perfect diversification in year one, but have a directional sense to that, right? So directionally, if you reach there in 4 years, 5 years, it's fine. Yeah. I think Vishal has a question.
Yeah. Vishal.
Yeah, hi Shruti. Thanks for the session.
Hi.
So I actually have two questions here. So first is, of course, that all of us have availed education loans, right? So, and one aspect of that is, of course, the tax saving part. So what would you recommend? Should we pay off the loans and invest in other tax saving investments? Or should it be how would you recommend we handle that scenario actually?
See, ideally, an education loan is considered to be a good loan because number one, you've taken a loan for adding a skill set to yourself, and second, you get those tax benefits. I never prepaid my loan. The simple reason being, it did not seem like a psychological burden to me. But if you think that you have other loans, if you are, say for example, you are also buying a house and you have a house loan and you have other family, maybe your family has a loan which you need to pay off. If there are too many liabilities, then yes, first the bad loans should be paid off. If there are any personal loans, pay that off. Any credit card loans, pay that off. Vehicle loans, pay that off. House loan and education loan are the two things that you pay off at the last, right? But if it is seeming like too much of a psychological burden to you, then yes, you can prepay it. But usually, loan is not the reason you can't invest. Yeah, you can always take out even 5, 10, 15,000 to invest. I could always do that. I did not do it. So I don't consider loan to be the biggest reason that you're not being able to invest, right? Yeah.
Right, Shruti. So just one more not follow-up exactly. So personally, I haven't invested in any products as of now. So if I have to start off, Like, what would be the right instrument to like start off with? Will it be mutual funds, or should I start off with just tax saving investments? So, what would be the right way to start off?
Tax saving investments you anyways have to do, but within tax saving investments also you need to make a decision of, do you want safety of capital versus, I mean, you can do mutual funds also in tax saving, you can do FDs also, you can do PPF also, right? You need to take that decision. So the way to think about it is, what do you want to save for? What is it that do you want to achieve? What are those different goals that I was talking about, right? So write down your goals, and when are those goals going to happen? So what is that timeline? How much of your money can you witness going down, right? Are you okay with seeing 30% loss on the screen? Will it give you sleepless night, right? So having an assessment of your risk appetite and knowing what you are investing for will make it easier for you to come to this answer of what instruments you need to invest in. Yeah.
Thanks, Shruti. Thanks.
Yeah. So yeah, so
Uh,
actually, I wanted to know, like during this pandemic times, a lot of clients who had invested with you, definitely the markets were not performing well. So there might be some issues, some challenges handling those clients. So my question, why I'm asking, is because I want to know, when you are doing your own startup or a business, when you are at a low end of your time, then how you handle your customers or your clients.
Yeah, that's a very good question, Sanjit. So actually, the markets did very well during the pandemic. The market has a brain of its own, and they are just not caring about the pandemic. So yes, the markets did go down. It was in March, April last year when the lockdown was first announced, right? And that was a very, very severe downfall. Although the downfall was very short-lived, it was just for 20-25 days. So even before people could really, react, it kind of bounced back. But yes, I mean, it does create a lot of panic, right? Mostly, the answer to handling clients at a low point is, when you're onboarding clients, make sure that, so what I do is, when I onboard my clients, I give them enough education about what is the experience they might have in the next 5 to 10 years with this money, what kind of upside and downside they might see. And then we invest a lot of time in keep continuing to educate them. So we write newsletters where we talk about how behavior is linked to money management. And when the markets actually went down, we sent a lot of communication to our clients. So all of the partners, we were available to take calls, individual calls of clients. We had very little redemptions, very little, very, very few people actually. It was only a few business people who were facing liquidity crunch in their businesses who actually took money out from mutual funds at that point in time. Very few people took money out. In fact, a lot of people wanted to put money in at that point in time. And why this happened is because of the amount of time we invested in educating them. Um, in in the last 20 years, when I saw mutual fund agents speaking to our parents, the push was very much on just selling the funds. If I can take my lens away from selling the product to thinking about how can I value add the client on a best effort basis, you'll be able to think like the client, and you'll be able to do things. You'll be able to visualize that situation, that when the market, when your business will not be doing very well, when you will be in a crisis, will these clients stand for you? Have you given them enough visualization of what it looks like to be in a crisis, right? And if that is something you can do, and this is more important in service industries. In product industry, generally you have sold a product, and if there is a crisis, it's a personal business crisis for you. Your ex-customers may not really understand the crisis, but with us it's very different. We manage people's money, right? So people get very, very panicked, and we have a lot of calls at that point in time. We do a lot of circulations, a lot of client communication. uh, we are always available 7 days a week. So those are times we handle it like that. And for us, the retention ratio is more than 98, 99%. So I think, so far we have been able to manage several crises, like that. So I think keeping client interest and client psychology in mind really helps you.
Okay, and what is your take on debt funds? Like, should we go for it? And if yes, what percentage of a portfolio?
See, what percentage of portfolio is a very customized answer. There's no, I don't believe in thumb rules, right? Debt funds also has various categories. So there are funds which are very low risk, like liquid funds and ultra short term debt funds, whereas there are credit risk funds which have sizable amount of risk. So the answer needs to come from the top level. That what is your risk appetite? What are you investing for? Do you really need debt funds? Right? What is your objective? Is your objective to earn slightly more than FDs? Then ultra short term debt funds won't serve your purpose. They are not giving more than FDs, right? So we need to understand the objective first, Sanchit, and then this allocation thing comes into play. To give you a thumb rule about allocation would be wrong advisory.
Okay, makes sense. Thank you.
Yeah.
I think most of the queries are solved, and it was really a great, insightful session. Thank you so much for having us here. Does anyone have a question?
Yeah, so maybe Tushal, what you can do is, since we are running out of time, you can share my email ID, with your batch, whoever is attending the session today. In case any of you have any queries, I would be happy to answer you on an email. And yes, it was fun interacting with you guys. The kind of questions you were asking were not some things that we thought about. At least I thought about when I was graduating from MDI. So, of course, awareness and technology and information is playing a key role now. And I think that's great. And all the best to you guys. And I had a lot of fun in the session. Thank you so much, Tushal and team.